Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Well, the ongoing market rally has propelled some modest gains for the FANGs as investors continue to hope that the group has fallen far enough such that it now represents something approaching a value proposition. Although I would have to say that the so-called value stocks have in general performed much better than the FANGs, also in general. But nothing that I am seeing suggests that the FANGs have reached anything like a sustainable low. Indeed, in response to that hope, when we look at the fair market value measures of the FANGs, we only find two of them that have positive fair market value, and one of them, Alphabet, is very marginal. Reviewing events in the NASDAQ in the 2000 to 2002 market setback, indeed going all the way back to the Nifty 50 stocks in 1973-4, it's very clear that until the high-techs and the Nifty 50 before them showed positive investment values, neither were able to find their ultimate lows. Having said that, there were several promising rallies on the way down, some quite sizable, and I can certainly see where they are likely to fall this time around as well. Last week, I told you that in this coming January, I will be conducting a free and public, full-scale, hour-long introductory webinar that outlines our service and the underlying methodology that you can attend live, but for which you need to sign up to reserve your spot, as enrollment tends to get filled up quite quickly each year. Registration will start as of today, and you can reserve your place by sending us an email with your full name to info@strategicanalysis.ca. See, at SCC, we have a strong community of investors who are not only able to use our service to better understand the market, but also to approach the market with greater confidence. This is especially true in our current uncertain markets where the stakes are so much higher than before. Now, if you would like to join us before the January webinar, we do have an exclusive offer to try out our service at a reduced rate. Go to www.strategicanalysis.ca/pricing and take advantage of this limited time offer by clicking on Insight Edge. When you sign up, you will get immediate access to our database of almost 3,000 proprietary SVA charts, along with all of the included service features, including an electronic copy of my book, Inside the Market, that explains how the SVA methodology works. Furthermore, all new clients get a personal and exclusive one-on-one introductory session with me that usually lasts an hour or so, and where I will go over how to use the system to better improve your returns. But please note, in the interest of full, true, and plain disclosure, SVA is a do-it-yourself investment service and is therefore not for everyone. It does take some time and effort to learn the ropes and be comfortable with the service. But for those who really want to learn how to use it and are ready to take that next step, it can prove to be a tremendous benefit to your investing future, as I hope that I will continue to show even today. Now, before we take a close look at those FANGs and what's going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Okay, let's start off with Amazon, and here is a very long-term picture of Amazon, actually going back to 2008, and you can see Amazon bottomed at its bubble price, and again very recently before breaking down. And that is a very, very significant break, because in the past I have seen when companies break their bubble price, they typically drop, and they typically drop at least 50%. Now, having said all that, I will have to say that one of our very alert users of our SVA service went back to 2008 and took a close look at actually what did happen there. And what you see here is that Amazon actually dropped to the bubble price and then one breakpoint below to its MSG price. So, did things fail to work? No. What actually happened here was we had a very sharp, remember that? 50% sell-off in the market from September of 2008 down to early November here at the bottom. And at the end, it was a very, very powerful decline. And Amazon actually dropped one breakpoint before very quickly getting back on side. And I want to say something about the MSG price, by the way, as well as the high conservation price, which is 1.5 times book. These are transition prices, and this transition is between what we would call super growth price and hyper growth price. And very, very often I have seen hyper growth stocks, or what we would call bubble stocks, and doing exactly the same, falling and dropping here before rallying. However, it always happens in extreme market movements, and I would hardly describe today as an extreme market movement. So this break, I think, is a harbinger of much lower prices. Microsoft, well, you know that they had a bit of a poor earnings and outlook report. The stock actually broke its HB1. I had been expecting, and I still do expect it to go to its bubble price, but in this rally, it has rallied back to the HB1, but which is 9.5 times book value. But the stock hasn't really, at this point, got a lot of traction, and recent action has been virtually flat. Alphabet, exactly the same story here. Going back a little bit to the last time that Alphabet cracked through one of the breakpoint values, its MSG price. Notice it sort of went back and forth over the line. What I call sloppy trading or uncertain trading. Okay, should we? Maybe not. Yet maybe so, and back and forth. And it looks like the stock may be doing that again. However, I have noted in the past that sloppy trading is almost always a harbinger of lower prices ahead. Netflix, of course, I had thought, wow, after that massive break from its HP3, which I'm not showing here, and with its long-term target at its super growth price, didn't quite get there because I think that the market was anticipating that it would actually get there. When we see stocks like that, we often get a rebound back to the bubble price, and it looks like the stock may be still trying to do that. Very, very recently, it broke out, looked very promising, failed, and now has tried once again, although the stock is now pulled right back to the MSG price. You'll have to watch that very carefully if you are still holding and hoping. Tesla had a very interesting, very recent low. On Tuesday of this week, Tesla hit its HB2 precisely and closed at $169.91. And look where the HB2 price is, $169.91. Well, as I have said before, this looks like a stepping downstairs kind of a movement. HB4 to 5, HB3 to 4, and now 2 to 3. But look again at the fair market value. That's a long way down from here. And I would be very, very careful that particularly with the earnings starting to level out a little bit here. NVIDIA has actually had quite a good rally here off its HB2, although at the time, of course, we didn't see that. It was only when the company reported and we got the new balance sheet that the thing actually bounced right perfectly off its HB2, because otherwise it had looked like it had broken down. It also appeared to be peaking at its actually I think at its HB3 price at the time, and it turned out with the change in balance sheet not to be the case. However, I am looking at the downtrend in the fair market value and the rest of the industry. The stock looks to me as if it's got miles to go on the downside before it's all over. Meta is perhaps the one stock among the FANGs that actually has some decent intrinsic value and has fallen so far from its bubble price, where we had a sell recommendation on it, down to its, that's by the way 7.4 times book value, down to its growth price, or 2 times book. You recognize that's quite a decline. And the stock looks as if it may be trying to get its feet back underneath it again. Unfortunately, of course, the intrinsic value, the earnings and the fair market value continue to fall and actually accelerate, so I'm a little bit concerned. Note that the stock is between 2 breakpoints, and I would never purchase a stock for the first time between 2 breakpoints. Either wait for it to retest its growth price again, or for it to break out over its mid-growth price. As I say, do not purchase between breakpoints, as there is no information value in price at those levels. Finally, Apple. Well, Apple continues to buy back stock. It looks very much to me as if we've been able to continue that downtrend due to buying back stock, that the stock may have bottomed right at its then HB6, which is what this line is here. But I think what I would have to say about Apple, as long as it's purchasing stock and its ROE continues to rise, whether I like it or not, we have to stay with it. Now, in summary, the rally in the NASDAQ 100 has been far less dynamic than the rally in what are called value stocks. The NASDAQ has only gained about 10%, for instance, against, for instance, the Dow 30, which has improved by some 18%, and by the way, is continuing apace today. This is highly reminiscent of what happened in the collapse of the high-tech stocks in the 2000 to 2002 market, and suggests to me, at any rate, that history both repeats and rhymes. Until the NASDAQ offers good investment value again, it is difficult to be optimistic for the long term about almost all of the FANG stocks. My message is there will be good trading opportunities ahead, and you need to stay in touch with the values here. But we are talking about trading values that lie ahead, not investing values. Big tech was bound to start missing earnings, having finally grown too large to be immune from a slowing economy. This earnings season has proven to be the case, with Amazon, Microsoft, Alphabet, Meta, Netflix, and NVDA, all with disappointing earnings and or guidance. Only Apple and Tesla are without major disappointment, at least so far. The challenge with these two, as I see it, is that their fair market value measures are so far below their price and price-to-book valuation. Amazon has given us what I would call the death cross when it failed to hold at its bubble price, and I would not wish to be long the shares here. I expect that Microsoft and Alphabet are clearly heading lower, with recent earnings and outlook disappointments showing the way. Meta is intriguing, as it has really fallen on hard times, down 73% top to bottom after my sell signal late last year. But on the positive side, it's one of two FANGs with positive fair market value potential as we measure it, albeit that the fair market value measure is heading sharply lower right now. The stock has a strong balance sheet, however, and Facebook is doing well. However, I don't know that this stock can go its own way alone without the rest of the FANGs. Be careful where you buy the stock, however, as I said. I had hopes for Netflix after it fell to its very, very long-term valuation low at super growth price, for the third time, by the way, 3.5 times book value, and had a beautiful rebound. I had thought, hoped, and maybe still do, it could go all the way back to its bubble price, as many failed hyper-growth stocks do, as they turn into merely growth stocks, and sometimes not even that. Last week, I observed that Tesla was trying to hang in above its HB2 price, and I suggested that if you'd like to remain positive, then by all means buy the shares at their HB2. That's 12 times book value, which it hit with dead precision on Tuesday. So clearly you've got to be very much on top of these stocks because it hit and bounced the next day. However, the downside risk picture puts me off for anything more than a quick trade. As far as Alphabet is concerned, I still expect the super growth price, 3.5 times book, is where the shares are going. But right at this very moment, I can see that the market is dithering about what to do with this stock. It is once again, as it did between May and June, trading either side of its next lower valuation price, its LSG price, or 4.5 times book, with weak buy signals actually on either side of that level. What I referred to as sloppy trading is again characterizing the stock. It is the second cheapest of the FANGs, which I suspect may be what is governing its market action. Apple remains everybody's favorite stock, and their share buyback program is keeping the stock valuation higher than it actually merits. I may not care for the stock at all at these levels, but I certainly do not fight City Hall. Microsoft has checked back to its key breakpoint after breaking down below, but as I said, I would not reverse my sell on this stock, given, for now, its weak numbers and outlook. Apple continues to buy back stock, and the return on equity continues to rise, keeping the stock valuation in price-to-book terms rising as well, although price itself is another issue. I've never been able to pull the plug in this stock, and this is the reason why. Now, the NASDAQ 100 has not found a sustainable low as of yet, and I need to emphasize that I have never seen a true bottom that has not come at one of our SVA breakpoints. Today may be the first time when it doesn't happen, although I sincerely doubt it, particularly when the overall NASDAQ values remain so poor. So, lots to keep in mind this week. As we've seen over the past 3.5 Years of our FANG Friday telecasts, these shrinking market giants, although not shrinking violets yet, have provided many opportunities to trade, both on the long and the short side, and nothing has changed this week. There's more to do, and there's more to do right now. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week, and don't forget to put your webinar registration in if you would like to see all the details of how SVA actually works and why.